remember, they're taking on extra risk, right? They're not doing their full underwriting, background check, everything. So what they end up doing is they take that extra risk and they price it right into your coverage, right? And so what ends up happening is typically as the consumer, you're paying anywhere from 2, even up to 4 times more for your insurance than you should be paying. Hey guys, Michael Garcia, I See Life here. Welcome back to the channel. Today what I want to do is just save you guys a ton of money protecting your home, protecting, for what many people is going to be their biggest asset is their home. So today's video is really for the homeowners out there when it comes to the insurance, protecting your home, making sure that, hey, something happens to you, that mortgage is paid off. But how do we do it in an efficient way, right? And so this video is for you guys. If you're a real estate agent or a mortgage loan officer, hey, pass this video on to your clients. It can save them a ton of money. We're going to be going into mortgage protection, what it is, how it works, and then how you can just do things more efficiently, right? This video might save you 10, 20, 30, 40, even $50,000 or more over the course of your lifetime. So what is mortgage protection, right? It's really simple, right? Mortgage protection is life insurance designed to protect your home, right? And so typically you have your PMI, which is going to protect the lender. Let's say you're not able to pay back that loan, right? That's why if you don't have at least 20% down, they're going to add that PMI to your loan. But the mortgage protection that you might hear, you might get a card in the mail, is for you, right? It's supposed to help you pay your mortgage. Let's say if you get ill, if you become disabled, if you pass away, what happens to your family? Does your family have that money to pay the mortgage? So it's a super important thing to have. You want to definitely have something in place to make sure that, hey, if something happens to me, my family can continue to live in this home. They can keep it. They can continue to live their lifestyle, right? So the issue I really have with mortgage protection is just this, right? Is that what is mortgage protection? It's life insurance. And so when you look at what life insurance is, it's insurance on your life, on your ability to go earn money, right? So you are your own most valuable asset, right? Your home would be probably your next most valuable asset, but you are your most valuable asset. And so the reason I don't necessarily like the term mortgage protection, even though I think it's super valuable and super important to have, and we're going to dive into it right now on the whiteboard, but the issue I have with it is, why would you only want to protect the portion or insure the portion of your income that pays the mortgage, right? Why wouldn't you want to insure your whole income? And so for me, it's not that it's a bad thing to have, it's just you're leaving the rest of your income unprotected, right? So let's talk about protecting your whole income as a whole. And what I think you're going to find is it's going to be a lot more efficient and cost effective for you to do so. You're going to save a ton of money and have a lot more protection. All right, so let's talk about what mortgage protection typically looks like, right? Or how you typically get it. So in most cases, when you buy a home or when you refinance, that information gets sent out, right? It's public information. Hey, there was movement on this house, right? It changed hands or there's a new loan on it. And so what ends up happening is you have a lot of these lead companies, and what they do is they're going to send out postcards, mailers out to your home. You might have 5, 6, 7 of these mailers or these postcards talking about protecting your mortgage or paying off your mortgage in the event something happens to you. Just fill this card out or call this number. You might have a handful of those right after you buy a home or you refinance, right? And so what ends up happening is the homeowner will fill this card out. They're going to send it back, or they're going to call the number on the card, and they're going to say, hey, I want to make sure that if something happens to me, my home's taken care of. Great, right? What happens from there is the lead company then sells your information to a insurance agent. And so a lot of these companies out there, this is how their business model works, is they buy leads, which is your information, and then they're going to give you a call and they're going to try to sell you insurance over the phone, right? Now, typically what this sale looks like, this is what you're going to see with a lot of these companies out there. So you may have heard of companies like Family First Life, Symmetry, Equus, right? A lot of these companies, they work off this lead-based model. And like I said, nothing wrong with it, but can we be more cost effective? We're going to see that in just a minute. So what they do though, is they're going to call you up. They're going to say, hey, homeowner, Mr. and Mrs. Smith, I'm getting back to you about the mortgage protection you requested, right? And they're going to ask you about how much your mortgage is. They might actually have that information, right? They're going to verify it with you. But then what they're going to do is they're going to try to close you over the phone, typically in about 30 minutes or less. They want to be done with this sale, right? They kind of just, it's a very transactional sale. They don't really dive too deep into what your situation is. They just want to know, okay, that mortgage is covered. And what they're going to do is they're going to sell you what's called an instant decision or a simplified issue insurance product that is going to get approved right there on the spot. Once it's approved, hey, it's in your inbox. It's nice and simple, which, hey, it's super convenient, right? The issue that you're going to see here in a minute is super costly too, right? And so we're going to break that down right now, but you got to just be aware that when you pay for something like this, or when you apply for insurance and they don't do a proper underwriting, they don't check, your risk profile in depth, it's like a super quick answer. Remember, they're taking on extra risk, right? They're not doing their full underwriting, background check, everything. So what they end up doing is they take that extra risk and they price it right into your coverage, right? And so what ends up happening is typically, as the consumer, you're paying anywhere from 2, even up to 4 times more for your insurance than you should be paying. And in some cases, it might even be 5 or 6 times. So we're gonna take a look at that right now. So let's go ahead and get into the whiteboard right now and take a look at what this looks like. So again, this is typically what you're gonna see. So like I said, these companies are out there. What they do is they get this card, they give you a call. Like I said, their goal is to close this right over the phone with you, right? And so in order to do that, they're gonna put this your information in right here. You're gonna say, okay, it's a $500,000 mortgage, male, California, and there's my age. I whited out my birthday for my own privacy, so sorry you don't get my birthday or height and weight, but you can see I'm 41 years old, and then it's gonna give you a bunch of quotes, right? And so all these products that they're gonna quote you are products that are a simplified issue, meaning, hey, as soon as we apply, we're pretty much gonna know if we have an answer or not. It's either approved or denied. There's no ratings, substandard ratings, none of that. So what this looks like is it comes out, they're gonna offer me this top product right here. So it's American Amicable, $196.20 per month, right? And so what that's gonna do is it's gonna cover that $500,000 mortgage of mine. So if I pass away, then my family has the mortgage paid off completely, right? And so great concept, don't get me wrong, right? It's a great concept, but can we do things more efficiently, right? And like I said, we're kind of neglecting the rest of our income, right? Well, that's great, you have the home paid off, but what about if your kids go to private school or play extracurricular activities, or your spouse is a stay-at-home spouse, right? And now they have to go get a job to pay for food and other bills. That doesn't cover that stuff, right? It's not going to cover the lifestyle stuff for your family. So what we want to do is actually protect your whole income, right? So what I did here, this would be the alternative. This is what I would call income protection versus mortgage protection. So what the insurance companies do is they basically say, hey, this person makes so much income per year. We can multiply that by as many years, assuming that you don't get any raises. Sometimes that's 25 times, 30, even 40 times what your income is. So let me just explain real quick. The insurance companies, what they're gonna do is they're gonna give you what they call a human life value number. And so basically they're gonna say, hey, if this person makes this amount, they do things well, this is how much we think that their net worth can be, or their lifetime net worth can be, right? And so they call that human life value. So they're never gonna insure you for more than they think you're worth. It's kind of like if you had a car, whatever that car is worth, that's what they're going to insure you for. They're not going to insure you for double what your car is worth, right? And so in the same way, what the actuaries do is they figure out, okay, well, we think this is what this person's human life value is. And so what I did here was we're taking somebody, let's just run an example, right? The mortgage was $500,000. We're going to say this is a person with let's call it $100,000 income. And so over the next 30 years, remember I'm 41, so if I work till 71, well, that would be $3 million assuming I never got a raise, right? And so it could be more than that, obviously, but that's $3 million of income, right? So what I did here was I laddered, I call this a ladder strategy, where you can get your $3 million, but every 10 years we drop. So you can see there's 3 policies here, 1 million, 1 million, and 1 million. And you can see it's for 10 years, 20 years, and 30 years. So in the first 10 years, all of these are in effect, meaning I have up to $3 million of coverage as soon as I get approved, right? As soon as this goes through underwriting and passes, I'm getting $3 million, and I'm getting it, as you can see down here, for $203. Now remember, if we compare this to the mortgage protection product, we were only getting $500,000, and it was costing us almost as much. It was costing us $196 a month. And so for just a few bucks more a month, we have $3 million. So we have 6 times the coverage at almost the exact same price, right? And so what's gonna happen too is you're gonna actually save a bunch of money right here, because what happens after 10 years is, after 10 years, this policy is going to fall off, right? And so what's going to end up happening is we're going to end up paying for just these 2 policies, right? And then we'll use a different color here. After 20 years, or the next 10 years, this one's going to fall off. And so we're only paying $123 a month over the course of those last 10 years, right? And so what that looks like from a long-term basis is I actually did the math for you here. And so if you look over here, this is the American General, the $3 million of income, right? You can see the 203 here. Well, what I did was, in those first 10 years, we're paying 203 per month, and that comes out to $2,400 a year. Multiply that by 10 years, and that's how you get this $24,000, right? And then the next 10 years, remember, this policy is going to fall off. You're going to be paying the 123 plus the 58. That's going to give you $169.85 a month, or $2,000 a year, $2,038, which comes out over the course of the next 10 years to be $20,382. And then the last 10 years, so now I'm 61 years old, this policy is going to come off. I still have $123 for $1 million of coverage in my 60s. And remember, the reason it's okay to have coverages drop off, there's 2 things you can do here. Number one, you can let it drop off. You can say, hey, you know what? It's been 10 years. I was covering 10 years of income with that first. I went and I made that $1 million. I went to work. I already made that $1 million. I used it. I paid down my home. I put money into my retirement. I don't need that $1 million anymore because I already went out and made it. So that's why it's okay. Like, hey, I want to drop this off. But keep in mind, you have one more option here. And so what that option is these policies over here are convertible. So over here, these policies are convertible, right? Meaning you can actually convert these term policies, and you can do it as you go, right? You can convert the 10-year policy into a permanent coverage, right? So that way you don't necessarily have to lose any of your coverage or the $3 million. You can convert it into a lifetime coverage one at a time, right? So you can actually keep all $3 million of coverage for your lifetime as well, right? That's the beauty of having a policy that is convertible into a permanent coverage. Over here with the American Amicable policy, you don't have that same convertibility, right? It's just kind of is what it is. You're not going to get a great product, or you can just convert it into another great product, right? And so when we look over here, if we add up all the premiums that you pay over the next 30 years, what we're going to see here is it's going to add up to $59,578, right? If we look at the 196, remember this is a flat 196 for 30 years. So 196 a month times 12 months would be 2354. And then you multiply that by 30 years. And what that's going to give you is going to give you $70,632 over those next 30 years compared to your $59,578. So the difference here is you're going to save about $11,000 over the course of your lifetime for the compared to the mortgage protection. The difference is you're going to have so much more coverage with the conversion rights. When you actually look at this on paper, it's just it's a no-brainer, right? And so when you think about, okay, should I go with the mortgage protection or should I go with more of a traditional plan where I cover everything I need? Well, yeah, let's cover everything, right? Let's cover for $3 million versus $500,000, right? And so to me, it's just a no-brainer. If we really look, if we dive further, by the way, let's go right back there. If we dive further, look, we have $1 million, $1 million, $1 million. But the thing is, I'm 41, right? So if I want to retire at 67, I don't necessarily need $1 million here in the 30 year, right? Because in 20 years, I'll be 61. I might only need to cover like 500,000, right? So if I actually drop this down to 500, what I'm going to have here is this might go down by about 50 bucks a month, multiply that by 30 years. And now my savings is going to be closer to $25,000, even $30,000. And that doesn't count the fact that I can add compound interest. I can set it in an account to grow it as well. So this is a big, big deal, guys. What's going to end up happening is you will save anywhere from $10,000 to $40,000. But it's $10,000 to $40,000 that you are going to save. And that doesn't even count the fact that, hey, you know what? I can actually put this somewhere and I can grow this money too. So it might actually end up being a net, $50,000, $60,000, $70,000 or more, right? Depending on what you do with that money. So that's why it's so important to understand what you're getting, right? And so I hope this video was helpful. If, like I said, if you're a homeowner and you bought coverage over the phone and they told you it was approved immediately, you might have American Amicable, you might have a company called Americo, you might have John Hancock or Mutual of Omaha. Like I said, none of these are bad carriers, but it's just the fact that the product that they offered is typically the simplified issue product that is, like I said, 2 to 4 times more. And so you're not getting the coverage that you should be getting for the price and the money you're putting into your policy. So if you want to review, please reach out. I'm going to put my information down in the description. If you're watching this and you are a real estate agent or a mortgage loan officer and you have a bunch of clients and you know that, hey, we just closed a home, we just got them in a home, and undoubtedly, hey, they got those same cards I mentioned. They probably called them, they wanted to protect their home. Well, you could potentially be your client's hero after this video. Give them a call, let them know like, hey, I got a guy that we can look at reevaluate your protection, make sure your mortgage is covered, make sure your family gets to keep your home, but we're going to save you a ton of money doing it. So anyways, hope that helps, guys. Till next time, peace.